Hello class, this is Econ 510 Managerial Economics class. Today is March 3rd, Thursday. The class will move on to chapter 7 of your textbook.
We're ready to talk about the profit-maximizing strategy of a firm. But before we get into the details, we need to make one thing very clear. The definition of profit is total revenue minus total cost. And total revenue, that is, the revenue that a firm earns from selling its product, is equal to the price of the product times the quantity that the firm sells. Now, here's what we need to make clear. Does the firm have the power to set its own price, or is the price given to it by the market? That is the firm a price taker or a price maker? Are they a firm that accepts the price as given, or does this firm have the power, by altering the amount of output that it produces, to manipulate its price? Later in this series, we're going to look at the decision that faces a firm that has the power to set price. We call that power market power. A firm that can influence the price of its product by changing the amount of output that it sells is a firm that is said to have market power. And an extreme example of market power is the monopolist. However, right now, to make the problem very simple, we're going to look at the other extreme, a firm that has no market power, a firm that takes prices as given. When a firm is unable to influence the price of its product, when a firm takes as given the price of its product that's set by supply and demand in the market, we call that firm competitive. The term competitive in economic theory refers to the behavior of a firm that cannot influence prices, the behavior of a firm or of any agent that must take prices as given. So in all of the analysis that we're about to do, all of our discussion of profit maximization, we're going to assume that we're dealing with a competitive firm. As far as our television factory is concerned, it cannot set the price of its televisions. The price at which it can sell its televisions is given to it by the market. Supply and demand out there in the big market determines that you can sell a television set for, say, $500. And if our firm wants to sell televisions at $500 a piece, we will imagine that they can sell as many as they can produce. If they try to charge $501, they will not be able to sell any televisions because competition will drive them out of business. On the other hand, why should they sell their television at $499 when they can sell all they want to at $500? If the firm is competitive, that is, if the price is set in the market and our firm is small enough so that its actions don't influence the market price, then the firm will always charge the market price for its product. It won't charge more because it will lose all of its customers. It won't charge less because then it would be giving up revenue that it doesn't have to give up. It will always charge the competitive price. So keep in mind now, as we launch into our discussions of profit maximization, that for the time being, we're dealing with a competitive firm, a firm that takes the price of its product and the price of all of its inputs as given. No matter how much output our television factory produces, it is unable to influence the market price. In the diamond industry, one big firm seems to run the show. It can control the price of diamonds and choose how many diamonds to sell. On the other hand, in the pork industry, there are lots and lots of small operations where pork farmers are aggressively competing and always concerned about what the price of pork will be by the time they get their pigs to market. The issue of how an industry is organized, whether it's one big firm or lots of little operations, is the question of market structure. Let's consider now different kinds of market structure and what it is that causes them to persist. The first case will be that of one big firm that runs the show in an industry. This is what economists call a monopoly. A monopolist gets to have the entire market demand curve to herself, and she can choose whether to charge a high price and serve a small number of customers, or whether to lower the price, increase sales, but make less off of each unit sold. The monopolist will choose the combination of price and quantity, subject to the market's willingness to pay, that maximizes profit. So how do you get in the enviable position of being a monopolist and having sole control over a market? Well, for a monopoly to persist, it takes barriers to entry. Barriers to entry are any things that keep other competitors out of this market. One barrier to entry could be a copyright or a patent, a drug company that has sole right to produce and sell a particular pharmaceutical, or a movie studio that has sole rights over the distribution of a film. A monopoly can also be held in place by sole ownership of a strategic resource. If one country has a particularly large stock of some strategic material like aluminum, and one firm has access to that resource, that firm will be a monopolist. Sometimes monopolies are granted by the government, as is the case with copyrights and patents, as is also the case when the government grants the license to some strategic resource to one particular firm. So many barriers to entry are legal barriers. That is, the government gives the right to this firm to be the sole operator in the industry. One other instance of barriers to entry is what we call natural monopoly. Economies of scale can create a monopoly, something about the technology that makes it reasonable or effective when one firm serves everyone. A modern example of a natural monopoly might be cable television. It makes sense for one firm to string all of the wires and serve all of the houses. You don't want a bunch of competitors out there digging up the streets in competition with one another. However, once the infrastructure, once the network has been put in place, there could be room for other competitors to enter. And this is what's happening right now in the electrical utility industry. It used to be that every city had its own power plant. Now that the grid has been strung, it may be that there's room for competition, and barriers to entry may be coming down. So the first instance of market structure is the single seller, the monopoly, and a monopolist is held in place by a variety of barriers to entry. A second kind of market structure is what's called monopolistic competition. Monopolistic competition is based on product differentiation. For example, in the fast food industry, you've got lots of businesses that are all selling quite similar products, that is, hamburgers, and through advertising, they create the impression in the market that their goods are in some important way distinct from one another, whether it has to do with being flame broiled, whether it has to do with being especially having special sauce, whatever it is. Each hamburger distinguishes itself from its competitors. And the money that's spent on advertising and the effort to create the impression of distinction becomes a barrier to entry. So what happens in this industry is that a bunch of similar firms carve up a larger market. The market for fast food hamburgers is carved up so that each player in this industry now faces their own individual demand curve. Here's the big demand for hamburgers, and here's the individual demand curve of a particular fast food restaurant. And firms will continue to enter until the market is full, until there's not room for another distinct kind of fast food. We call this industry monopolistic because each firm faces its own downward sloping demand curve. Once you've carved out a niche in this market, you can choose the combination of price and quantity that maximizes profits. We call it competitive because new firms will continue to enter, continue to advertise and distinguish their products until the market is saturated. That is, until there's not room for another firm to come in, launch an ad campaign, and make enough off of their fast food business to justify the expense of differentiating their product. Monopolistic competition, an industry where the firms behave competitively in order to get a monopoly. Now, a third kind of market structure also involves a small number of firms. This is called oligopoly. An oligopoly is distinguished from monopolistic competition by the motivations and behavior of the firms. In oligopoly, what happens is you have a small number of firms that are protected by barriers to entry. For instance, the airline industry or the cigarette industry. And what's important in oligopoly is that firms are always watching each other. That is, firms are behaving strategically. They're trying to figure out how their rivals would respond to their launch of a new line of cigarettes, or raising or lowering the price of their product. What distinguishes oligopoly from other market structures is the regard that other firms have for one another. That is, they're always keeping an eye on each other, trying to figure out what their rivals will do next and what their best response is to any moves by their rivals. So oligopoly is distinguished by strategic interaction. So what does the demand curve look like for an individual firm in an oligopoly? Well, that depends on the kind of game that the firms end up playing. But one suggestion is that the firm will face a kinked demand curve. That is, if they lower their price, all their rivals will follow them, trying to keep up. But if they raise their price, the other firms will hang back and let them lose market share. So in oligopoly, there's no agreed upon demand curve. The real issue is strategic interaction and gamesmanship. A final market structure is the one that economists seem to have the most definitive things to say about, and that is the case of perfect competition. Perfect competition exists whenever all of the firms are so small that none of them can really have any direct influence on the price. The determining characteristic of perfect competition is that a firm can sell as much output as it's capable of producing without affecting the market price, simply because the firm is so small. Perfect competition is a market in which there is, for all practical purpose, no barrier to entry, and firms will continue to enter as long as they can cover the cost of producing the good. We may have a whole bunch of firms, and what happens now is that the firms act as price takers. They're so small relative to the market that no one thinks that they can influence the price of the product. The demand curve for an individual firm in a perfectly competitive industry is a horizontal line. That is, it's perfectly elastic. The firm knows that if it raises its price above the market price, it will lose all of its market share because there are plenty of competitors willing to serve the market at the going rate. On the other hand, no firm would lower its price below the market price because they can sell everything that they can produce at the market price. Why leave profit sitting on the table? So, in a perfectly competitive industry, each individual firm faces a horizontal demand curve. The assumptions that underlie this view of the market are as follows. First of all, buyers and sellers have perfect information about the quality of products being traded, and they can quickly discern where to get the best price. Next, the same product is being sold by all the firms in the market. The product is homogeneous. There's no important difference between the product being sold by firm A and firm B. This is the case in agricultural markets, where all the farmers who are selling number 2 red wheat are selling exactly the same product. Also, there are no important barriers to entry. No barriers to entry created by government regulation, no barriers to entry created by economies of scale, no barriers to entry created by copyrights or patents. In this case, the large number of small firms competes very aggressively with one another on price, and their interaction with buyers will determine the market price, and each firm in the market faces a horizontal demand curve. Because the price is not influenced in any way by the quantity that an individual firm produces, we say that for a perfectly competitive firm, marginal revenue equals price. That is, the amount of money that's added to the firm's revenue when it produces an extra unit of output is simply the price at which that firm can sell that product. Now, that won't be the case for a firm that has market power. That won't be the case for a monopolist, a monopolistic competitor, or an oligopolist, because the amount that you sell could very well, either through strategic interaction or through market saturation, cause the price to go up or down. But for a perfectly competitive firm, it's going to be all about what's happening on the cost side, because your revenue is going to increase at a constant rate whenever you increase your output. So there you have it, market structure. And it really is all about barriers to entry. When there are lots of barriers to entry, a firm may get a monopoly. Whenever the barriers to entry are a little bit lower, but firms still have to spend money to distinguish their products from one another, you get monopolistic competition. Whenever barriers to entry create a situation in which firms are regarding one another strategically, keeping an eye on each other, trying to second-guess each other's next moves, then you have an oligopoly. And finally, when there are a whole lot of small firms that end up acting as price takers, then you have a perfectly competitive market. We'll see as we go on how each of these market structures has its own unique set of determinants of the price of the product in equilibrium. And you'd like to know, how much should I produce so as to make the most profit I can from my operation? We're now entering a set of lectures that's going to equip you with the tools economists use for describing the behavior of profit-maximizing firms. In order to get to the question of what a profit-maximizing firm should do, we have to back up and start with some basics. The first thing we'll do is describe the technology of the firm. That is, what can the firm do with a given set of inputs to produce a certain amount of output? We're going to describe the technical or technological possibilities that a firm has for producing output from input. That is, for assembling television sets or making hamburgers. Once we have a description of the firm's technology, we will then look at the cost to the firm of producing output. What we do is we take the technology and combine that with knowledge of the prices that the firm has to pay for its inputs, like labor, raw materials, capital, and come up with the cost per unit of making hamburgers or televisions. Finally, we'll combine the information we have about the costs of production with information about the price at which the firm can sell its product. Once we've combined those pieces of information, we'll be able to predict the best course of action for a profit-maximizing firm. We'll be able to answer the question, how much output should a firm produce if it wants to maximize its profits, subject to its technology, the price it pays for its inputs, and the environment, the competitive environment in which it finds itself. So let's back off then of this big picture and focus on the first set of specific questions we'd like to ask. That is, what are the technological possibilities of a firm? That is, what can the firm do? We're looking now at a firm's technology, and a technology simply means a catalog of things that a firm knows how to do. What we're most interested in is how much output a firm can produce with a given amount of input. Now, this sounds a lot like engineering, doesn't it? It's because it is. Economics, when we describe production, begins with a purely engineering relationship. That is, a relationship that has nothing to do with economics and money and stuff like that, but has more to do with technological possibilities. What can the firm do, according to the laws of physics, according to its know-how, to turn labor and raw materials into its finished product? Now, we're going to start with a careful description of a firm's technological possibilities. And then we're going to look at how to represent those technological possibilities in a graph. Finally, we'll introduce some concepts that economists focus on when they describe the technology that a firm uses to produce its output. Let's start then with a chart that shows the technological possibilities that the firm faces. It's kind of like a production possibilities chart for the firm. And we call this production possibilities a total output relationship. Total output is defined as the total amount of output that a firm can produce using a given amount of input, subject to its technological know-how, and any other factors that constrain its production. What a firm can do, given its know-how, with a certain amount of input. Total output, therefore, is the amount of output a firm can produce with a given amount of input. Let's look at the technological possibilities of a particular firm. Let's say this firm produces television sets. So their output in this case is TVs. And their input, let's say, is labor. Now, when we describe this relationship, total output, we're talking about what labor can produce, what a given amount of labor can produce in terms of television sets. But clearly, we need other inputs to make a television. We need raw materials, we need tools, we need a place to work. Whenever we describe the total output relationship in economics, we are usually talking about the short run. The short run is a period of time that is so short that you can only vary one or a few of your inputs. A plant that's producing televisions might decide over time that it wants to expand its operations, add another conveyor belt, get some more tools, build another warehouse. Well, you can do all that stuff in time, but in the short run, if you got a big order for television sets, you could only meet that big order by hiring more workers to come in and work with the factory as it exists now. The short run is a period of time during which some inputs are fixed and other inputs are variable. So when we describe the total output relationship, the first thing we want to do is to distinguish between fixed inputs and variable inputs. Let's suppose now that we are in the short run in our television production process. We're building TVs and suddenly we get an order to increase the number of televisions we're making. Maybe we get a big order from a department store. In the short run, let's suppose our only option for increasing output is to add more labor. Everything else is fixed in the short run. It's too expensive to alter quickly the number of conveyor belts, the size of the factory, the number of tools, and so on. So for all practical purposes, our only variable when we're altering our output is labor, and we will call labor the variable input. Now, let me go back and define total output one more time. The total output of the variable input labor is the total amount of output that a given amount of labor can produce, holding constant technology, that is the firm's know-how, and holding constant the quantity of all of the other inputs that the firm uses, capital, the size of the factory, tools, anything else. We're going to consider those the fixed inputs. And whenever you write out a schedule like the one in front of me here, you're assuming that those fixed inputs remain fixed in the short run. So we've got a certain factory size, a certain number of conveyor belts, a certain pile of raw materials to work with. But in the short run, we can only produce more televisions by adding more labor. Let's look then at what the possibilities are in the short run. In the short run, if you have one worker, you can make 2 television sets per week. If you add a second worker with the same tools and the same technological know-how, you can make 10 television sets in a week. Employ a third worker, and the 3 of them can produce a total of 30 television sets in a week. 4 workers have a total product of 40 televisions per week. 5 workers will give you a total output of 45, and with 6 workers, you can make 48 television sets per week. As you see, as the numbers get larger, up to a point, the total output of labor increases. Oddly enough, if you go past a certain point, with 8 workers in this story, the total number of television sets actually drops by 1 from 49 to 48. This table of numbers, then, is a total output schedule. It shows you the total amount of output you can produce with given amounts of the variable input labor, holding constant technological know-how, and holding constant the amount of all other inputs used. The next thing I'd like to do is represent this information graphically. So, in the next lecture, we'll take this chart of numbers and put it into a picture. That picture will represent the production possibilities of the firm in the short run, and we will call that the total product curve. You want to know how your business is doing. Are you going to be around a year from now, 2 years from now, 5? What numbers should you look at to gauge your progress? How would an economist advise a business owner to figure out whether the business is really, in some long-run sense, earning a profit? Well, here's the idea. Economic profit is the difference between the revenue that a firm earns and the sum of the opportunity costs of all the resources that are employed at that firm. As long as revenue is greater than the sum of the opportunity costs, the business owner can afford to pay all of the resources a salary that is better than their next best alternative. That means they'll be willing to stay and work with this business as long as revenue exceeds opportunity costs. But if revenue falls below the combined opportunity costs of the employed resources, then the business is in trouble. One by one, the resources will seek alternative employment where they can earn more money. This is the notion of economic profit and why it is that it's important that a business owner pay attention to it. Let's consider now the difference between the way economists reckon profit and the way accountants reckon profit. It turns out that if you use accounting profit as a guide, you can sometimes get a faulty picture of how your business is doing, and that could lead you to make mistakes. Let's consider then the way accounting profit is calculated. Accounting profit is the difference between the revenue that a business receives and all of the expenses that the business pays out. So suppose now we're running a retail television business. You're selling television sets to people who come in off the street. You've advertised in the newspaper. You've made a name for yourself, and now customers come in, interact with your salespeople, and decide whether or not they want to buy a TV set. Let's suppose that in one particular year, the revenue earned by this television business is $100. How would an accountant calculate the profits of this business for that year? Well, the first thing we do is make a list of all of the resources that are being written paychecks by the manager, and we would add up the expenses. So one of the first expenses is going to be the cost of goods sold. That is, all of the television sets that we've bought from some wholesale operation that we're now selling retail. And let's suppose that the cost of goods sold for this operation is $30. So out of our $100 worth of revenue, we've got to take $30 of it to write checks to our wholesale provider of television sets. Let's suppose that the other expense that we have is all of the help that we have to pay wages to. And let's suppose that for the sake of this example, our workers have combined wages of $30. So that's another $30 worth of expenses that this business has. And let's suppose that that's all the checks that we are writing out of our checking account for this TV operation. That means that $100 worth of revenue minus $30 worth of wages minus $30 for cost of goods sold leaves an accounting profit of $40. $100 minus $60 in total expenses. So the accounting profit in this case is going to be what's left over, and that is equal to $40. Now, what happens to that accounting profit? The accounting profit then is divided among other resources that are employed in this business that don't figure explicitly into the costs. Who are they? Well, for one, there's the manager. If the manager is not paying himself a salary explicitly, then he gets to take a share of the profits. Who else gets a share of the profits? Well, any investors that put their money into this TV store, maybe so that the TV store could afford to buy inventory, so they could afford to accumulate other kinds of capital that are important to their operation. Inventory is a really good tangible thing to think about why you may need to borrow money in order to run a TV retail store. So the money that's left over, the accounting profit, is available to be divided between the manager and the stockholders. Now, can we tell by looking at this picture whether or not our firm is going to be around a year or two? And the answer is no, because we have no idea from this reckoning how much the manager could earn somewhere else, and what the shareholders could earn somewhere else, and for that matter, what the workers could earn somewhere else. It's only when we see that all of the resources employed are earning more in this business than they could earn in their next best opportunity that we can conclude this business is going to be a going concern. That's what economic profit is about. So what we do next is we add up the opportunity costs of all the resources that are employed, and we figure out whether this firm is earning enough revenue to cover those. Let's start with the cost of goods sold. These television sets that we are selling to our customers, what's their opportunity cost? Well, if we imagine that the wholesale television business is a very competitive business, you could turn around and rather than sell these television sets to the public, you could sell them right back to the wholesaler and probably get your original $30 back. So the opportunity cost of the televisions that we're selling to our customers is probably exactly what we paid for them, $30, because we could always sell them back to the people who sold them to us. So the opportunity cost of our cost of goods sold is probably pretty much the same number that was on our accounting books. The workers, however, probably are another story. We're paying them a total of $30 in wages, but their next best opportunity is surely lower than that. If the market for labor is very tight and very competitive, then the $30 might be their opportunity costs, but chances are they're doing better in this operation than they would be doing at their next best alternative. That's why they've chosen to work in TV retail. Let's suppose that the next best alternative for the workers would pay them not $30, but only $20. In that case, these workers are delighted to have the retail TV job because their opportunity cost is lower than what they're actually being paid. Think about it. These workers are making, in some sense, a profit. They're earning $30 here while their next best alternative is $20. We call the extra $10 that they're earning at the TV store economic rent. Economic rent is defined as the amount that a resource is paid in excess of its next best alternative, in excess of its opportunity cost. So all we know here is that we've got to pay our workers at least $20. We happen to be paying them $30. But $20 would be enough to keep them in this employment. The big difference between economic profit and accounting profit is that economic profit includes the opportunity costs of all the resources employed, not just the ones that explicitly get paychecks. For instance, the next step in calculating economic profit is going to be to include the opportunity cost of capital. What could our investors earn if they put the money that they presently invested in our television retail business into some alternative? Let's suppose that a comparably risky investment would earn a 20% rate of return. That means that if our capital owners have put $50 into this business, say $50 that's lent to us so that we can acquire an inventory, if they put that money instead into the stock market or into a bank account, they could earn 20%. 20% times $50 equals $10. So $10 in this case is the opportunity cost of capital, what our capital owners could have earned if they had invested the same amount of capital in a comparably risky investment. So let's go ahead and put $10 here as the opportunity cost of capital. Of course, that means that if we don't pay our capital owners at least $10, they're going to start looking elsewhere for investment alternatives. Another resource that's not explicitly accounted for in accounting profit is going to be the manager. Particularly if the manager is not paying himself a salary, he may not show up anywhere over here on the books. But certainly he has an opportunity cost. He could take his talent and go manage some other business. And suppose his next best alternative would allow him to earn $20. So $20 then is his opportunity cost. If he doesn't get paid at least $20 for a year's worth of management expertise, then he can't be expected to stay with this firm. So what we've done here is we've added up the opportunity costs of all the resources that are employed at this business, whether they're explicitly receiving a paycheck or whether they're getting bonuses or dividends or whatever and not actually on the accounting books. They're considered here in this reckoning. Add up the opportunity costs, subtract the opportunity costs from the revenue that's earned, and we get what's called the economic profit. Economic profit is the amount by which the revenue exceeds the combined opportunity costs of all the resources that are employed. And this economic profit then will be divided among the employed resources in the form of rents. We've already talked about how the workers are getting $10 worth of economic rent. They're being paid more than their opportunity costs. Maybe the manager is being paid $25, which would be $5 worth of rent for him. And maybe the shareholders are getting $15, which would be $5 worth of economic rent for them. So the economic profit then is going to be divided among the stakeholders in this business, whether they are capital suppliers, the managers, the workers, or anyone else. The sum of the economic rents will be equal to the firm's economic profit. So, we can conclude by saying that if the firm were not making an economic profit, it wouldn't expect to be around very long, because the various resources, the manager, the workers, the capital, all these resources would go off in search of other alternatives, other opportunities that had higher returns. But as long as the firm is making a positive economic profit, it can afford to pay all of its resources enough money to keep them interested in working for this business. If the opportunity cost of capital is greater than the accounting profit, well, there you have it. The firm looks like they're doing okay, but in reality, they're winding down because the economic profit will be negative. Negative economic profit means in the long run, you're out of business. Even though the books may look good, because you haven't taken account of other factors of production that aren't being explicitly paid paychecks, you could make a mistake in management. Economic profit is a notion that helps you consider whether or not your firm is actually doing well enough to stick around. Now, there's one more point I want to make about the difference between accounting reckonings and economic reasoning, and that's the issue of sunk costs. Sunk costs are amounts of money that you pay that you will never get back. The acquisition of inputs that immediately have zero opportunity cost. Here's a parable about sunk costs that makes clear why economists are so eager to resolve the confusion about them. Suppose you join an expensive health club and you have to pay all of your membership dues up front. And the first day you enthusiastically go to the health club and play a vigorous game of tennis. Now, being out of shape, you're probably going to really hurt your tendons, and the next morning you wake up with tennis elbow. And you think to yourself, you know, my arm hurts, but since I already paid my dues, I really ought to go work out again. And you do, and the arm gets worse. And the next day, and the next day, until finally you show up with the doctor, hardly able to bend your arm, and the doctor says, gosh, you're being really foolish. Every day when you go to that health club, you're hurting your arm worse. Why do you keep showing up? And you say, because I already paid my dues. Well, this is the problem of the fallacy of the sunk costs. You're never going to get back the money that you paid for your membership. So every day when you wake up, you should make the decision afresh. Because the membership is prepaid, it costs you zero to go down to the health club. Are you getting enough benefit to cover that costs? Not if you're hurting yourself. In that case, the benefit is actually negative, and you are shrinking your profit by showing up. The way you should make a rational decision about costs that are sunk is, what would it cost me to bring this project to completion? And what is the benefit that I can expect once the project is completed? If the benefit is greater than the required additional costs, go for it. But if not, it doesn't matter that you've already put money into this project. That money is sunk. You're not going to get it back anyway. It shouldn't influence the decision about whether to go forward. Even though costs show up on your accounting books, some of them that are sunk should be ignored for the sake of decisions that are forward-looking. Always consider how much it will cost to bring a project to completion and how much benefit will be derived. If the benefit is greater than the cost, it makes rational, good, profitable sense to carry the project out. If not, don't let sunk costs become a kind of neurotic guilt that influences your actions in the present in a way that makes you do unprofitable things. What's already paid is sunk, and the economist advises you to ignore sunk costs for the sake of rational, profit-making decisions. Imagine you're running a television factory and you want to make maximum profits. You're trying to decide how many television sets to produce. What rule are you going to use to decide whether to produce one more television set? The answer is, you'll produce an extra television set anytime that extra set adds more to your company's revenue than it adds to its costs. You're never going to produce a television set that costs you more at the margin than the revenue that it adds. That would be subtracting from your profits. But the rule of producing up to the point at which marginal cost is just equal to the price That's the rule that a competitive firm uses to maximize its profits. Let's look at how that rule looks in a graph. We're dealing with a firm in the short run that's trying to maximize its profits, and we've made a particular assumption about that firm. We've assumed that it is a competitive firm. Now, I haven't used this term before, but now is a good time to introduce it. A competitive firm is a firm that can take any action it wants to. It can produce as many television sets as it chooses to without influencing the price of its product. A competitive firm is a firm that can take any action without having an effect on the price of its product. Therefore, the price of your product is a given, a constant, something determined in the market that you have no control over. We've imagined that our competitive firm, in this example, can produce televisions at a price of $500 per television sold. That is, the price is constant at $500, no matter how many televisions you produce and sell. If that's true, will you produce another television set if you want to maximize your profits? The answer is, it depends on the cost of producing that television set. The cost of producing an extra television set is called the marginal cost of producing that set. The marginal cost of production, if it's less than the price, signals you to produce the television set and thereby increase your profits. But if the marginal cost is greater than the price, producing that television set would actually reduce your profits, and therefore it's not something you should do. Let's look now at this story in a picture. Here's a picture that you're familiar with from our last discussion. The total revenue curve is a straight line away from the origin, which represents the situation of a competitive firm. You can produce all the television sets you want to and sell them at a constant price of $500 apiece. The total cost curve now has a shape that reflects the productivity of the firm. First, you have diminishing marginal cost as marginal product increases due to teamwork and specialization. And then you have increasing marginal cost as congestion of the fixed inputs occurs. We now want to represent this picture, the same information, in this graph below. I'm using another one of my double-decker graphs, which means I have to be clear that on the horizontal axis I'm measuring the same thing. In this case, I'm measuring output on both of these axes, and I'm using exactly the same scale. Now, the first line that I'm going to draw in the diagram below is the firm's marginal revenue. Marginal revenue is defined as the change in total revenue that results from a change in output. Now, how does marginal revenue change? How does the firm's total revenue earned change if it sells one more television set? The answer is, it changes by $500, the price of the television set. It doesn't matter whether it's your first television sold, your 10th, or your 100th. Each television sold will always add $500 to your total revenue. $500 is the marginal revenue, which in this case, the case of a competitive firm, is equal to the price of a television set. A quick note, for a competitive firm that cannot influence the price of its good, marginal revenue is always equal to the price of the product. So let me draw in a line that represents marginal revenue. In this case, marginal revenue is the price of a television set. And price of the television set will always be equal to $500. So here I have a line with a slope of 0. It represents a constant, and this line is representing the price of a television set. In my story, that's $500. Now, let's represent next the marginal cost of producing a television set. Where do I get information from this picture on marginal cost? Where in this picture do I see the marginal cost of production? The answer is, it is the slope of the total cost curve. Remember, marginal cost is defined as the change in total cost that results from a change in output. It's the rise over the run, the slope of the total cost curve. So I want to graph a picture of the total cost curve, and let me see where the inflection point is. It looks like the inflection point might be right about here. This is the point where the total cost curve is no longer concave and becomes convex. that is, the slope stops decreasing and starts increasing instead. So if this is my point of inflection, this will be the point at which marginal cost is at a minimum. The slope has decreased and decreased and decreased and decreased, and it's just not going to get any lower. So here's the point of minimum marginal cost. Now, two other points that I want to notice. First of all, this point right here, this output level, in our last lecture we called this output level Y star. This is an output level at which the slope of the total cost curve is the same as the slope of the total revenue curve. This is an output level at which price is equal to marginal cost. So marginal cost at this point will be equal to price. And I can call this point Y star, just like I did before. That's Y star. Over here is another point where the slope of the total cost curve is equal to the slope of the total revenue curve. And this point before I called it Y dagger. Y dagger is another point where marginal cost is equal to price. Y dagger. That's the point at which losses are maximized, by the way. All right, now, if I keep the marginal cost diminishing until I reach the inflection point and then have it rise after that, I will be drawing the slope of the total cost curve in this downstairs graph. So let me do that. Here's diminishing marginal cost, bam. Then marginal cost increases, bam. And there's your marginal cost curve. Again, what have I drawn here? This marginal cost curve is simply the slope of the total cost curve at every point. And I had some points that I knew had to be on the curve. The point of inflection, where marginal cost is at a minimum, and these 2 points where marginal cost is equal to price, Y dagger and Y star. Now, I can use this diagram down below to make an intuitive point about profit maximization. I argued before that this point, Y star, was the point of maximum profit for the firm. How do I know that? Well, if I look in the upstairs diagram, I know that because that's the point where the gap between total revenue and total cost is the biggest. That's the point where profit is maximized. But downstairs, I can tell the story a different way, using a different intuition. Let's suppose now that you run that television factory and you're producing at this point Y star. Is that a good point for you to be at? The answer is yes. If you increase your output beyond Y star, what's happening? You're adding $500 for that television. If you produce another television at that point, you're adding $500 to your revenue. But the amount that you're adding to your costs is greater. What does that mean? It means that that next television is actually shrinking your profits because it costs more to produce than it earns you in revenue. So you don't want to go past the point Y star. You also, however, don't want to decrease your output. If you decreased your output, you would lose $500 by not selling a television set. If you back off and produce one less television set, you're going to cost your firm $500 in lost revenue. How much are you saving on the labor that you're not employing? Well, notice the savings is less than $500. The savings is less than $500. So you're sacrificing $500 in lost revenue, but you're only saving yourself maybe $450 in costs that you don't incur. It's not worth it to save $450 if it means you're throwing away a $500 sale. Therefore, you don't want to move backwards from that point either. If you're at this point Y star, where price is equal to marginal cost, you do not want to produce an extra television set. You also do not want to produce one fewer television sets. This is the point that is unimprovable. This is the point at which profit is maximized. Suppose we were back here at another point. Let's say this point of inflection. Just pick it, for example. Is this a good place for your firm to operate? The answer is no. How do I know? How could you improve your situation if you were at this point, if you were producing this smaller quantity of television sets? How could you improve the situation? You could produce more television sets. If you produce more television sets, notice, each television set that you produce adds how much to your revenue? $500, the price of the television set. Each one of them costs how much to produce? Well, some amount less than 500. Notice the green line is below the blue line at that point. If marginal cost is less than marginal revenue, if marginal cost is below the price of the good for a competitive firm, you can always increase your profits by increasing your output. As long as the cost is less than the price, by all means, make more television sets, drive up your profits. If you're over in this region and producing a large quantity of television sets and the marginal cost is greater than the price, by all means, back off. Produce fewer television sets, because the money that you save by not producing those television sets, the money you save by not employing the extra workers, is greater than the money you lose on the lost sales. You economize more by not hiring the workers than you would lose by not producing the televisions. So back off. Save more than you lose in revenue. Save more by economizing on costs. It's only at the point where marginal cost equals price, it's only at this point that the firm cannot improve its situation. Now, one final note. Look over here at Y dagger. Y dagger is another point where price is equal to marginal cost. Y dagger, on the other hand, is a bad point, because anything you do, any movement away from Y dagger makes you better off. If you're at Y dagger and you increase your output, what happens? Well, look, you're adding television sets that earn $500 a piece, and the cost is less than $500. Get away from Y dagger, increase your output, because price is greater than cost. As you increase your sales, that's going to add to your profits. The televisions cost, or the televisions are bringing more in revenue than they cost to produce. Look, even if you reduce your output, you're improving your situation. Because if you back off here, each of those televisions is bringing in $500, but they're costing more to produce at the margin. So if you reduce your output away from Y dagger, then you're saving more in labor costs than you're losing in lost sales. Y dagger is an awful point. In fact, if you look at the picture, you can see it's the worst you could possibly do. It's the point of minimum profit, the point where cost is the highest above revenue that it ever gets. So let me summarize. The point at which profit is maximized is the point where price is equal to the marginal cost of production. This is the rule for profit maximization for a competitive firm. Any competitive firm, to maximize its profits, must be producing at the point where price equals marginal cost. There's one additional condition, and that is, it's not enough to be at the point where price equals marginal cost. You also have to be at a point where the marginal cost curve is sloping upwards. That is, you have to be at a point where marginal cost is increasing. That's what distinguishes Y star from Y dagger. Y dagger, where marginal cost is decreasing, is a terrible point. It's the point of minimum profit. Y star, where marginal cost is increasing, is actually the point of profit maximization. So our two conditions are, first, price equals marginal cost, and next, that the marginal cost curve itself must be upward sloping at that point. Marginal cost must be increasing. If those two conditions are satisfied, then the firm is maximizing its profit in the short run. We just developed a firm's rule for profit maximization. The rule is produce where price is equal to marginal cost and make sure that marginal cost is increasing. What I want to do in this short segment is apply that rule to the numbers that we were looking at a moment ago and make sure that it jives with our calculations of profits in a real example. Then I want to prepare you for the next step in analyzing a firm's profit maximization decision. So let's look at our real numbers. In our real numbers from a moment ago, we saw that profits were maximized when the firm was producing 48 television sets. Not surprisingly, notice that if you calculate the marginal cost of production, that when you're producing 48 television sets, the marginal cost of production is $333. That's just under $500, which is the price of a television set. If you go beyond to produce the 49th television set, the marginal cost of a television set has risen to $1,000. Marginal cost is now greater than price, and the firm can improve its position by cutting back on its output. Anytime marginal cost is greater than price, you can reduce your marginal cost by reducing output and getting back in the direction of profit maximization. Notice here that the firm is maximizing profit. Profit continues to increase as long as marginal cost is less than price. But after marginal cost exceeds price, profit begins to decline again. One more thing to notice about these numbers is this. Marginal cost is equal to price when we're producing 2 television sets. Marginal cost is $500 per television set. But notice, however, at that point, marginal cost is declining. It's going from something to 500 to 125 down to 50. Marginal cost is decreasing at that point. And as we talked about a moment ago, if you produce where price equals marginal cost and marginal cost is decreasing, then you're going to be minimizing profit. And that's exactly what we wind up with. Price equals marginal cost gives us the smallest profit number, or the biggest loss that we earn in this whole table. So our 2 rules then to repeat are price equals marginal cost, and make sure marginal cost is increasing to make sure you're at a profit maximum instead of a profit minimum. Now, all this talk about price and marginal cost increasing, this is the rule for a firm to do the best it can with what it has. This is the way a firm maximizes its profits. However, just because a firm is maximizing its profit doesn't mean that the profit is positive. Maximizing a profit and minimizing a loss amount to the same thing. How do we make sure that when a firm is maximizing its profit, when it's doing the best it can, that it's actually making a positive profit instead of a loss, a negative profit? Well, this is where those average cost curves come back in. The average cost curve doesn't tell us about what's happening at the margin. It looks at the whole picture. It summarizes everything going on in the firm to tell us the cost, on average, of producing a television set. The average cost tells us the per unit cost of producing a television set. As long as the price is above the per unit cost, the firm is maximizing its profits and making a positive profit. If the price is below the per unit cost, the firm is making a loss. So when you find that point of price equals marginal cost, and the marginal cost curve is increasing, once you've found the best the firm can do, then compare the price at that point with the average total cost. And that lets you know whether the firm is making a positive profit, or if price is less than cost, making a loss. We'll do that next when we look at the curves. Just because a firm is maximizing its profits doesn't mean it's actually making a profit. It could be minimizing its losses instead. How do we show the total profit that a firm earns when it's doing the best it can? I'll use now the graphs that we've developed, the cost curves, and use them in conjunction with the price of the product to show you what profit maximization looks like when the firm is earning a profit and what it looks like when the firm is making a loss. Let's start with a fortunate firm that's making a profit. Now, what is profit? Profit is the difference between total revenue and total cost. And the profit per unit that a firm earns is the difference between the revenue per unit, which is equal to its price, and the cost per unit, which is equal to average total cost. Let's look now at the diagram and bring those concepts into clearer focus. We'll start with the cost curves that we developed in the last series of lectures. Here's the marginal cost curve that tells us the cost of producing an additional television set. Here's the average total cost curve that tells us the total cost per unit of producing television sets. And notice that varies as labor productivity varies. Here's the average variable cost curve that tells us the labor cost per television produced. Once again, varying as labor productivity varies. And the difference between the average total cost curve and the average variable cost curve, what is that? It's the average fixed cost. Average variable cost plus average fixed cost equals average total cost. And why is it that the average total cost curve and the average variable cost curve get closer and closer as output increases? It's because average fixed cost is headed towards zero as we spread the fixed cost out over more and more units of output. Now, let's see what's going on in this firm. Let's suppose we have the price of the product. In our example, we've been looking at television sets that sell for $500 a piece. We have a competitive firm here that can produce as many televisions as it wants to and sell them at $500 a piece. It's competitive, which means that it cannot influence the price of its product. Whether it produces a lot or a little, it can still sell its televisions for $500 a piece. Now, if the price is $500, how many television sets will this firm produce if it wants to maximize its profit? Let me give you a chance to answer that question. Where in this graph will the firm be operating if the price is here and the firm wants to maximize? The answer is, take the price and go over to the marginal cost curve. Remember, the rule for maximizing profit for a competitive firm is the firm produces up to the point at which marginal cost equals price. Don't go past that point, or your costs will be greater than revenue for each additional television set. If it costs more to produce the television than you can make by selling it, then you're cutting into your profits. But don't stop shy of that point. If you stop short, then you're giving up profit because the revenue on those televisions is greater than the cost of producing them. Keep producing up to the point at which price equals marginal cost. That will maximize your profits. That means our firm wants to produce an output, and we'll call this output Y star. That's what we've been calling it all along, the output that maximizes profits. Now, we've got a firm here that's doing the best it can. A firm is always going to produce where price equals marginal cost and the marginal cost is increasing. That's the best a firm can do. That's the point of profit maximization. Now, however, we're going to ask ourselves, when this firm is doing the best it can, well, how well is it actually doing? Is it making a profit? Is it making a loss? What? How is this firm doing? Well, in order to answer this question, let's again think about profit. Profit is total revenue minus total costs. If you look at the picture that we've drawn here, you can actually see the firm's total revenue. Where is it in this picture? Where in this graph can you see the firm's total revenue? Remember the definition of total revenue, price times quantity. Total revenue is seen in this picture as the area of this rectangle. The height of the rectangle is the price the firm charges for its product, and the width of the rectangle, or the base, is the quantity that the firm produces. Price times quantity gives you the area of this rectangle that I've drawn here as a black box with dotted lines here and the axes as the lines on this side. This rectangle right here is the firm's total revenue from selling this quantity of televisions at this price per unit. Think of this as a big chunk of money that the firm takes in. Now, here's the question. What does the firm do with the money? Who gets it? Who is entitled to the revenue that the firm takes in from its sales? Well, let's look at the diagram here. The first thing we notice, if we look at this quantity Y star, let's imagine that this is 48 television sets. If the firm is producing 48 television sets, we can go up from 48 television sets. We can go up from Y star and find this point on the average variable cost curve. What does this point tell us? If we follow this point over to the axis, it gives us a dollar value. The question I'm asking you to answer is this. What does that dollar value tell us? 48 television sets. Here's a point on the average variable cost curve. What is this amount of money on this axis going to tell you? It tells you the labor cost per television produced. It tells you how much you have to pay your workers for each television they produce. Now, if you take the average variable cost, the labor cost per unit produced, and you multiply it by the number of units that are produced, what do you get? You get the variable cost, the total money that you're spending in your firm to pay your workers who are making your 48 television sets. So, if we multiply the number of units that are produced, the base of this rectangle, times the average variable cost, that is the labor unit per television, multiply that by 48 televisions, and this little area down here at the bottom is the firm's variable cost. Now, you can think about this as kind of a parfait, one of those desserts that has lots of different layers. The bottom layer of our parfait is the variable cost, the amount of money that the firm has to pay its workers who are producing the 48 television sets. So if I want to, and I do want to, I can label this particular chunk of the parfait with a VC. This chunk down here at the bottom, and I could shade in the whole thing, but I don't want to make my graph too cluttered. This whole bottom chunk of the parfait is what's going to the workers. This is the chunk of total revenue that goes to the workers to pay them for their labor. Now, if we follow our 48 television sets further up, we hit another curve. The next curve that we run into is the average total cost curve. So if we follow this dot over to an amount of money on the axis, what's it going to tell us? We're producing 48 television sets, and this is the point that we touch on the average total cost curve. What does this amount of money tell us? It tells us the average total cost per television produced. That includes all the workers, as well as all the capital we're using, tools, factory space, resources, everything else, all those costs that are fixed in the short run. So this little chunk of the parfait now that's sitting on top of variable costs, what is that? That's average total costs after you take out the variable cost. Well, what's left? What's the difference between total cost and variable cost? The answer is fixed cost. The difference between the average total cost curve and the average variable cost curve at every point is the average fixed cost. If you multiply this average fixed cost times those 48 television sets, times the number of units that you're producing, what do you get? Well, average fixed cost times the number of televisions you're producing is just fixed cost, the total fixed cost. Let's put fixed cost now in this picture. And I could shade in this whole area, but again, I don't want to confuse the diagram. So this whole area right here, the second layer of the parfait, is the fixed costs. All right, quick review. We've got this big black rectangle which represents the firm's total revenue, price times quantity. We went up to the average variable cost curve and identified average variable cost when we're producing 48 televisions. We multiplied that by our 48 televisions and we got variable cost, the total wage bill that this factory has to pay. That comes out of their revenue. Next, we looked at the difference between average total cost and average variable cost, and what's left over is the average fixed cost. We multiplied that by our 48 television sets, and that gave us the fixed cost of production. Now, if we add fixed cost and variable cost together, what do we get? We get the total cost of production. And if we subtract the total cost of production, these two bottom layers of the parfait, if we subtract them from the big black rectangle, what's left? What's total revenue minus total cost? The answer is, it's the profit of the firm. That is, the layer that's left on top After we've subtracted fixed and variable cost, the layer that's left on top is the firm's profit. And I'll use the symbol pi to indicate that. So, by way of review, here's the way we examined the firm's profit-maximizing decision and their profit position. First, we took the price of their good. They're a competitive firm, they take the price as given. We then let the firm maximize profit by continuing to produce until marginal cost was equal to price. That gave us Y star. Y star is the profit-maximizing output of this competitive firm. Notice it's where price equals marginal cost, and it's where the marginal cost curve is sloping upward. This is the best that our firm can do. Then we broke down total revenue into some chunks. First, we found average variable cost using the ABC curve and multiplied it by output to get the bottom chunk of our parfait. This is the chunk that goes to the workers. Then we found the difference between average total cost and average variable cost. That's average fixed cost. We multiplied that by our 48 television sets and got the fixed cost. What's left over is the difference between total revenue and total cost. And that is, by definition, the profit of the firm. Now, I'm going to do the same set of steps, the same analysis on a different firm. This firm is not going to be as fortunate because it's going to turn out that they are in fact not making an economic profit in the short run. They'll be making a loss. Let's examine now a different situation. This is the last lecture in our series on productivity, costs, and profits. In this lecture, we'll be looking at the effects of the expansion of an industry, and we'll be deriving a tool that we call the long-run supply curve. Let's start with revisiting the relationship between the market and the individual firm that we derived last time. So here we have the market equilibrium, the demand curve, which is the behavior of households and consumers, and the short-run supply curve, which is the sum of the marginal cost curves of the individual firms. In the short run, the supply curve and the demand curve intersect and give us an equilibrium point. We'll call this P0, and a market quantity, we'll call this Q0. Now, if we take this price over into the diagram for the individual firm, we see that in long-run equilibrium, the firm is making zero economic profit, and the firm is producing at the point of efficient scale. This is a long-run equilibrium. The only way we can have a long-run equilibrium is if no firm wants to change its behavior. In this case, the firm is maximizing profit by producing where price is equal to marginal cost. And the firm is breaking even by producing where price is equal to average cost. There is zero economic profit, and therefore no tendency for entrance or exit. Everything is stable in this market. Let's upset the equilibrium now by changing the demand for the product. If we change the demand for the product, and the demand curve shifts up to this new point D prime, then we have an excess demand for the product at the old price. And the bidding mechanism then will push the price up so that firms supply a larger quantity and the quantity demanded decreases, so that the price goes up to this point here. Now that would be the short-run equilibrium, and the firm would move along its short-run marginal cost curve over here in this diagram. I'm not going to draw the short-run marginal cost because my focus here is on a different story. I want to know what happens as new firms enter the market? What happens to the costs of production? As new firms enter the market and the short-run supply curve shifts outwards, representing an increase in the number of firms offering trucking services, it may be that as these new firms enter the market, that they drive up the cost of production for all firms. Suppose that truck drivers are in short supply. If truck drivers are in short supply, then as trucking companies try to expand their operations, they're going to be bidding up the salaries of truck drivers. And as the salaries of truck drivers rise, then the costs of production for every firm in the trucking industry are going to increase. When this happens, the cost curves shift upward, and the cost that firms can afford to operate at will be rising. That is, the point of minimum long-run average cost will be shifting upwards. So what we have then, as the short-run supply curve shifts outwards and firms enter the industry and compete for a strictly limited resource like talented truck drivers, the costs of production will shift upwards, and we will get something like this. A new long-run average cost curve at a higher level. If expansion in an industry causes the cost curves to shift upward like this, we say that this is an increasing cost industry. If the expansion of the industry causes the cost curves to shift upwards, we call it an increasing cost industry. What we're saying is, as the industry expands, competition for a strictly limited resource will in fact increase the costs of all firms in the industry. This was the case in the computer industry in the late 1970s, early 1980s, when there was a limited supply of talented computer programmers. It took a while for students to go to school and learn computer programming, and of course those students were attracted by the promise of higher salaries. But in the short run, as computer companies tried to expand their operation, competing for a pool of talented programmers, they pushed up programmers' salaries through competition, and that raised the cost of production for all of the companies. Now, what does this mean? It means that there will be a limited amount of entry before the price falls to the point at which firms can just afford to cover their costs. The break-even point for firms has shifted upward as the cost of production has increased. That means the price for the product cannot fall back to its original level, but can only fall as low as the new point of minimum average cost. That new point of minimum average cost might be not 8 cents a mile for trucking service, but 12 cents a mile for trucking service. The increase in costs limits the amount by which the short-run supply curve can shift outwards. This new price, P1, has to be the new equilibrium price. It's the new price that's given by the intersection of short-run supply and demand. It's the new price that we have in long-run equilibrium. Firms are breaking even, and the quantity supplied equals the quantity demanded. If I connect these two dots, I get what we call in economics the long-run supply curve. The long-run supply curve shows what happens to minimum average cost as an industry expands. In our case, we were talking about an increasing cost industry. When an increasing cost industry expands, the minimum average cost of production rises as firms compete for a strictly scarce resource and push up the cost of production. The long-run supply curve in this case is upward sloping. It is possible that you have what's called a constant cost industry. A constant cost industry would be one where, as the industry expands, the costs of production do not change for the individual firms. In that case, the short-run supply curve would keep shifting outward until our price fell back to 8 cents per mile, the original minimum long-run average cost. In that case, the long-run supply curve would be a horizontal line. The short-run supply curve would keep shifting out until it intersected the demand curve at the original price, the original minimum long-run average cost. One more possibility: what if the expansion of an industry actually decreases the cost of production for individual firms? What if we have a decreasing cost industry? What if a large number of firms in an industry actually lowers the cost for each firm in that industry? That could be the case, say, in software design, where you have a bunch of software engineers who work in a market, and with more people trying to solve the same kinds of problems, they're able to solve them faster. They share ideas. Everyone's working on the same problem, and therefore it takes less time to solve it. In an industry like that, a large number of talented software designers lower the cost for each other by working on common problems and sharing insights with each other. That leads to what's called a decreasing cost industry. As the industry expands, the cost of production actually fall. And in that case, the long-run supply curve would be downward sloping. So, a quick summary. The long-run supply curve tells us about the relationship between the size of an industry and the cost of production for an individual firm in that industry. If expansion of the industry pushes up costs for individual firms, we call it an increasing cost industry, and the long-run supply curve slopes upwards. That will be the case if expansion in the industry heats up competition for a strictly scarce resource, like talented programmers or certified truck drivers. It's also possible that expansion of the industry leaves costs unchanged. That's what we call a constant cost industry, and that would give us a long-run supply curve that's horizontal. Finally, it could be that expansion of an industry actually reduces costs for the individual firms. This would be the case if growth in the industry allowed communication among the participants or other ways of economizing on costs, external economies of scale, we call it sometimes in economics, where the growth of an industry lowers costs for everyone. In that case, the long-run supply curve will be downward sloping.